Hello everyone, welcome back to the channel. Tonight's developments in the Middle East have jolted markets worldwide, and the scale of the blowback is still reverberating. It's not just a regional flare-up anymore, it's the kind of crisis that can reshape portfolios, test central banks, and shift global risk appetites. So today, we're going to walk through what's happened, why markets are reacting so violently, and what you should be watching as things unfold. It all began with an audacious Israeli strike on multiple Iranian targets, including nuclear and military installations. Reports suggest the Israelis aimed to cripple Iran's nuclear enrichment sites and missile capabilities, striking deep within Iranian territory. The operation was not a small-scale raid, but appears planned to send a clear message that Israel is willing to escalate beyond the shadows. The reaction was swift. Iran retaliated with missile and drone strikes on Israeli cities, including Tel Aviv, Haifa, and suburban regions, some of which penetrated Israel's air defenses. Civilian casualties were inflicted, infrastructure was hit, and there were alarming reports that some strikes even impacted areas near diplomatic or U.S. interests. Iran also threatened that any country aiding Israel could become a target. As the tit-for-tat escalated, markets began digesting what looked like the beginning of a broader regional war. Now, when a geopolitical shock of this magnitude lands in a region so central to global energy, trade, and strategic choke points, markets have no choice but to reprice everything. The immediate victims: equities, energy, safe havens, and risk assets broadly. Let's break down the market reactions. First off, oil. Crude surged. Brent crude jumped 7% overnight, climbing above $75 per barrel. Some reports even suggest intra-day moves of 9% in extreme volatility. The logic is obvious. Any threat to Middle East supply, disruptions to shipping routes like the Strait of Hormuz, or damage to oil infrastructure introduces supply risk. Higher oil carries inflation risk, higher input costs for industries, and the specter of stagflation. Then there's safe haven demand: gold, U.S. treasuries, the Swiss franc, Japanese yen. They all got a lift. Investors hit the panic switch and fled toward assets perceived as more stable. Treasury yields fell as bond prices rose. The dollar strengthened in many corridors, especially as a global reserve asset with safe haven appeal in times of stress. Equities suffered badly. In the U.S., the Dow dropped nearly 1.8%. The S&P 500 and Nasdaq also slid sharply. European and Asian equity indices followed suit. Markets in Germany, France, the UK, Japan, and Hong Kong all saw declines of 0.5 to 1.5% or more. Airline stocks and firms exposed to fuel costs or logistical disruptions were especially punished. Meanwhile, defense and energy companies saw relative strength, investors betting on higher demand for military hardware or energy revenues. There's another twist. Some markets reacted positively. In Israel, ironically, stock indices surged to record highs. Financial Times Israel's TA35 and TA125 indices both posted strong gains, interpreted by some as investor confidence that Israel, or by extension its economy, can withstand conflict and push back aggressors. Financial Times: this divergence highlights how local sentiment, defense spending, and conflict dynamics can create anomalies amid broader chaos. Volatility measures spiked sharply. The VIX, Wall Street's fear gauge, jumped as investors reassessed risk premiums and positions. In short, the market priced in a risk premium for geopolitical escalation on top of existing financial stress. Now the question becomes, how far can this go? Markets hate uncertainty. And the more this conflict broadens, if other states join, if supply lines are interrupted, if major powers get involved, the greater the systemic risk. Some analysts now warn of stagflation, weak growth accompanied by rising inflation. Others caution that markets might be underestimating the depth of geopolitical risk or falling into complacency. We also need to see how monetary authorities respond. Central banks are sitting on a tightrope, already facing inflation pressures, contending with slowing growth, and now dealing with an exogenous shock. Do they tighten further or lean dovish to cushion the blow? Either path carries risks. Let's highlight some key indicators to watch. Oil futures and supply disruptions. Any attack or blockade on shipping routes or oil infrastructure will instantly spook markets. Bond yields and credit spreads. If yields rise too sharply, borrowing costs will choke growth. If spreads widen, credit stress emerges. Safe haven flows, sudden spikes into gold, Swiss franc, or U.S. Treasuries can signal panic mode. Equity sector performance. Watch divergence between defense, energy, airlines, and broader markets. Response from global powers, U.S. involvement, sanctions, or military posturing could escalate or contain the conflict. Finally, what should you do, or at least, what cautious pathways exist? First, avoid over-leveraging or speculative bets in such volatile environments. Second, maintain diversification and a bias toward liquidity to allow repositioning. Third, keep an eye on geopolitical intelligence, not just market charts. News can move markets harder than technical signals during crisis. Fourth, for those with exposure to energy or emerging markets, consider hedges or protective allocations. In closing, shocking night. Israel's retaliation sends global markets into chaos. Is not just a dramatic headline, it reflects the very real interconnectedness of geopolitics and finance. Events in one region can ripple instantly across currencies, commodities, stocks, and bonds. The coming days will test whether markets stabilize or spiral further, and whether diplomacy or escalation dominates the trajectory. Stay alert, stay nimble, and don't let noise derail your long-term view. Thanks for watching. If you found this useful, hit like and subscribe, and I'll see you in the next update.